Hello, Jeff Brown with Brown Wealth Management here. We posted a new article on our blog today. We titled it, "Does the S&P 500 have that COVID antibody?" Granted, it's a little play on words, but it's remarkable that the US unemployment rate jumped to almost 15% in April, that manufacturing activity is plunged to its lowest level since the Great Depression. On top of that, we've had earnings estimates just tumble for companies in the S&P 500. And yet the stock market has rallied over 30% off the lows and is only down about 12% for the year as of last week. So we examined how could this be possible? Well, first off, a couple quick things. First off, the stock market's a leading indicator. It typically bottoms for about 4 months before the recession actually ends. And those are some of the strongest gains that occur at that very beginning. So it's very tough to predict when the market will actually rebound if you're looking at the fundamentals of the economy. Secondly, the stock market actually does better when the unemployment rate is high, believe it or not. And third, the market does better when effectively earnings expectations for the future are very, very low. These are all contrarian things and not what the normal public would think about. So we examine that in our article and the reasons why. And finally, I think one key thing that makes a lot of sense here is that a lot of companies in the S&P 500 are doing okay right now. We broke them down by companies that are faring all right versus companies that are faring poorly. And although the companies that are faring poorly are a subsector of our stock market, the ones that are doing okay are a much bigger percentage of the market cap weightings. So check out the article and let us know what you think if you have any questions.